Would you like to know the secret to better mental health? I would hope that everyone, none of us are perfectly sane. Did you know that? If you think you are, then you're obviously more bent than the rest of us, right? So let's talk about how to have better mental health. I want you to know that in this world, there are things you cannot control and things you can control. Which of these should we not worry about?
Things you can't control.
Yeah, so let's start with things you cannot control. There is nothing I can do to change climate change. Now you guys are, wait a minute, well, couldn't you drive a Prius? No, first of all, I'm way too stylish to drive a damn Toyota Prius. I'm surprised you guys didn't find that humorous at all. Okay, so no, I'm not going to drive a Prius, but assume that all these little things, whatever I do, I am one person out of 8 billion. Is it really going to make a difference what I do? No. So that's something that I can't control. Should I sit around and worry about climate change? No. Now let's talk about the things I can control. Should I worry about these things? The most common answer is yes, but I'll tell you the answer is no. Don't worry about them. Do something. Right? I'm not going to, so for instance, with the climate control or climate change problem, I can't control where I live. My wife and I used to talk about retiring to Texas. Do you think that's still on the table? I don't know if you've been to Texas lately, but it's kind of hot and dry these days. And would you want to move to Florida? No, I can control those things. I'm not going to worry about it. Does that make sense? So, in the end, what should you worry about? Nothing. Do not worry about anything, and once you get that figured out, you'll be amazed at how much better your mental health is. Questions? Okay, so let's get into Chapter 12, which is risk, cost of capital, and capital budgeting. You guys have been in finance now for at least a year and a half, 2 years, and so far we've basically been handing you the required rate of return. So you got this present value, future value problem, and we say the required rate of return is 6%. Do you think that's how it happens in the real world? No, the number is not just handed down to you by the gods of finance. You've got to figure that out on your own. And so that's where we are going to get into this material for Chapter 12. What is that rate supposed to represent? It's supposed to be a representative of the risk. And so that's our first hint as to how we're going to get to that number. We're going to have to look at the risk. By the way, this is the beginning of a new unit. Unit number 1 was all about capital structure. How do we finance the assets of the firm? Unit 2 is all about capital budgeting. What assets should we be selecting? By the way, those are 2 independent decisions. Don't ever let anyone tell you those 2 things are tied together. You go to the car lot and you're talking about a car and you say, how much? And the guy's like, well, what kind of payment are you looking for? Like, no. We're going to talk about what this worthless car is worth. And then we'll discuss after that what the financing options are. So don't ever let them mess with your head like that. Okay, so we are now trying to answer this question of what should we buy? And one of the things that we have to have for that is the required return. So how are we going to figure this out? Well, it turns out we have these amazing labs that price risk. And those labs are called the financial markets. Those labs are called the financial markets. So we've got financial securities out there that we know the riskiness of the cash flows and we know what the required return on those is. And so what we're going to try to do is find a financial instrument that has the same risk as the cash flows of the project, and then that will be what we use as our required rate of return. So it sounds really easy, but it's not quite as easy as you might think, and there's going to be a lot of swag involved. What is swag? Scientific wild-ass guess. So we're going to be doing a lot of expected values and things like that. Okay, so the big two financial instruments we're talking about here are bonds and stocks. And we have markets for both of them, and it turns out that most firms have a mix of debt and equity. And what we're going to do to figure out the firm's cost of capital, which is based on the riskiness of the firm's assets, if you think back to Modigliani and Miller, we will be using that information to figure out what is the firm's cost of capital, and that's going to represent the cost for anything that has the same risk as the overall firm. Any questions so far? Okay, now let's talk about the cost of equity capital. Every firm has equity in its capital structure. Does every firm necessarily have debt in its capital structure? No. You can have an all-equity firm. Can you have an all-debt firm? No. Someone has to own something that's the equity. Okay, so firms are not required to pay dividends. A lot of times students get into the idea then that equity is free. Does that sound right? No. If people aren't getting dividends, what are they expecting?
Capital gain?
Yeah, capital gain. And so equity is not free. And we need to figure out what is the cost of that equity. And it turns out we have two different ways of doing that. Have you guys studied the capital asset pricing model and security market line? That's one of them. And the other one is the dividend discount model or dividend growth model. And so we're going to look at both of those ways. Hopefully this bit of the lecture will just be reviewed to you. But I know that I never learned anything on the first time I hear it. So maybe this will be new to you. Who knows? So here we have the security market line. What does the E stand for over on the left-hand side?
Expected?
Yeah, it's expected. And remember, expected values are just swag, scientific wild-ass guess. This is because we cannot tell the future. And so we've got the expected return on the security, I, is equal to R sub F. What's R sub F?
Risk-free.
Yeah, the risk-free rate. And what do we typically use as our substitute for the risk-free rate?
Treasury bills?
Yeah, treasury bills, typically the 3-month. Then we've got beta sub I. What does beta represent? What kind of risk?
Market.
Yeah, market risk, systematic risk, undiversifiable risk. This devil goes by many names, but beta represents that. And then we're going to multiply by this stuff in the brackets. And inside the brackets we have the expected return on the market minus the risk-free rate. By the way, the risk-free rate, notice we don't have an E by it, but we have E by the return on the market and the return on the security. Why is that?
You can always know the 3-month.
Yeah, you always know the risk-free rate. So it's not a variable, it's not stochastic, it's not move around on you like that. It's fixed, it's known. But this other stuff is all expected values. So this thing that's in the square brackets, expected return on the market minus the risk-free rate. What do we call that bit?
Market risk premium.
Yeah, the market risk premium. The market risk premium. And I want you to notice that if we subtract R sub F from both sides, we have that the risk premium on the stock is equal to beta times the market risk premium. Remember, the risk premium is defined as the expected return on something minus the risk-free rate. The expected return on the market minus the risk-free rate is the market risk premium. The expected return on the stock minus R sub F is the risk premium on the stock. And the way those two things are related is through beta. If your stock is 3 times as risky, you're going to multiply that market risk premium by 3 to get the risk premium on the stock. Is firm-specific risk represented here at all? No, why not? Why is firm-specific or idiosyncratic risk not priced at all? It's also called it's also called diversifiable risk.
No, it assumes it's diversified out.
Yeah, so we assume that the prices in the market are set by people like me who hold a diversified portfolio. Therefore, I am only subjected to the systematic risk. I don't have to take on that diversifiable risk. That means that my required rate of return will be lower. Therefore, I will be willing to bid more. And so we can think of the stock market as a big old auction. The people who get the stock are the ones who are willing to bid the most for it. Those are the people who have the lowest required return. The people with the lowest required returns are the ones who have diversified away all of that firm-specific or idiosyncratic risk. Okay. Any questions so far? So what do we need to make the security market line work? Well, we know we need an estimate of that risk-free rate. We also need an estimate of the market risk premium. And I want to take a minute here to tell you that on these problems, the most common mistake students make is failing to read. And so what will happen is I will give them the market risk premium. Then they will treat that as the expected return on the market and subtract the risk-free rate out of that. Wrong, because the risk-free rate's already subtracted out of a risk premium. Therefore, we shouldn't do that. Or I'll give them the expected return on the market and they'll treat that like the market risk premium. So those are the two common mistakes. Being successful with a finance calculation is almost always as much about reading as it is about calculating. So be sure to read carefully and know what you've got. And then finally, we need an estimate of the equity securities beta. So where do we get these things? Well, finance professionals tend to use the yield on the 3-month Treasury bill. So remember, there's 2 kinds of risk when you loan somebody money. First of all, there is default risk. What's default risk? Yeah, it's the risk that they don't pay. In theory, Treasury bonds and bills do not have the default risk. Why?
Government can always print more money.
Yeah, government can always print more money or raise taxes, and so that's why you don't see default risk for U.S. Treasuries. Now, do you see default risk for other countries' stuff? Yes, even though they have the capability to print money. Keep in mind that there's risk in printing money. What if a country just starts printing money to pay their bills? What happens?
You get higher inflation.
Yeah, inflation just goes through the roof. And if you've ever met anyone from Zimbabwe, they can tell you horror stories. Venezuela's another one of those. In fact, Venezuela's currency costs more to print than it's worth. And they don't print their own currency. They actually have to buy it from a company in the United Kingdom. It's a big old mess. Okay, so we have a stable economy, we have a stable government, we have basically zero default risk. What's the other kind of risk that comes when you loan somebody money?
Interest rate risk.
Yep, interest rate risk. And interest rate risk is dependent on the amount of time to maturity. And so you could have a treasury bond, 30-year, And it will have some interest rate or price risk. But if you've got a treasury bill that's down here with just 3 months to maturity, then that interest rate risk is quite low. Now, it turns out there are things called 1-month treasury bills. And they would have even less price or interest rate risk than the 3-month treasury bills. Yet we do not use them for estimating the risk-free rate. And the reason we don't is because they're not very popular and they don't trade all the time. So we don't have always fresh, up-to-date, really good information on their yield versus the 3-month. So when you're working a problem, if I give you a treasury bill, that's what you're going to use. What if I give you a 3-month and a 1-month? I won't do that, but if I did, you would go ahead and use the 3-month because that's our benchmark. Okay. Questions? By the way, where do you think I would get information on treasury bill yields? You guys are about to graduate with a degree in finance. Where would you go to find that information?
Broker.
Say again?
Broker.
Yeah, you could go to your broker's website and you could look it up in your account and whatnot. That's one thing you could do. What else?
Google.
Yeah, so I would just Google, and what you'll find is that every single one of the 12 Federal Reserve banks has data, free to download data on their websites. And one of the pieces of data that they have free to download is the yield on the 3-month treasury bill. Now, here is a bit of trivia for you. There are 12 Federal Reserve banks. Do you know which state is the only state to have 2 Federal Reserve banks?
Missouri.
Yeah, it's Missouri, right? We've got Kansas City and we've got St. Louis. Our people here at Missouri State tend to go to the Kansas City Federal Reserve for employment. Very few of them land up in St. Louis. Did you know, though, that we are actually in the St. Louis Federal Reserve District? It's just the way the line's drawn. It's really weird. You'd think we'd be in Kansas City, but we're not. Okay, any questions? So now we're going to talk about estimating the market risk premium. So if you're looking at the capital asset pricing model, you're supposed to know the market portfolio. But do we actually have the market portfolio? No. So if you think about the market portfolio, it's every risky asset known to man held in proportion to its importance in the world economy. And so we cannot possibly have fresh prices on every risky asset known to man. For example, is my house a risky asset? Most people say no, but the answer is yes. And I can tell you personally from having lost $39,000 on a house in Mississippi that I owned for absolutely 10 months, a house is a risky asset. Now that we've established that it's a risky asset, can I figure out what is the price of that asset today? So my house, I bought my current house in 2007. Can I figure out what is the price today?
An estimation.
It's an estimation only, right? Because the only time we know a true price on the house is when it transacts, right? That's the only time we know a true price on that house. So there hasn't been a real true price on my house for 18 years. Now, you probably are thinking about Zillow and Redfin. If you go out and look at those websites, are they going to give you the same number? Probably not. And so you assume that, well, one of them is correct. Is that necessarily true? No. In fact, in a market where houses aren't selling at all, then those estimates are likely quite stale. For example, does anyone know what's going on in Florida? Everybody wants to get out of Florida, or at least not own a house there. And so people have their houses up for sale, but nobody's buying. So what does that mean to the freshness of those estimates on Zillow and whatever? they're stale. And in fact, if something does sell, it's going to sell for much lower than those estimates. Okay, so now that we have settled that we cannot possibly know every risky asset known to man and their values and returns, we say, well, what can we do for a stand-in? And the answer is the S&P 500. Now, the S&P 500 has a couple of issues as a stand-in. Number one, it's an American thing. We're talking about 500 U.S. companies. Now, those companies are globally diversified, but they're still U.S. companies. The second thing is that there are only 5,000 or 500 stocks in there. There are many more stocks than just that. Why do we focus on that? Well, first of all, they actually choose these 500 stocks to become a reflection of the U.S. economy. Once again, reflecting the U.S. natured bias of this thing. And the second thing is that it's a market value weighted index. In other words, the companies that have larger market values, they are represented more heavily in the S&P 500 than, say, smaller companies. Right now, 7 companies represent 40% of the value of the S&P 500. Now, why is the market value weight better than a price weight? It's because we're talking about, when we said about the market portfolio, we said every risky asset known to man held in proportion to its importance in the world economy. That's a market value weight, not a price weight. By the way, which of our other indexes that we talk about quite a bit is a price-weighted index? When you hear people on the news, people who don't know squat, and they're talking about the stock market, which index do they always talk about?
NASDAQ?
No. Swing and a miss. I like it. They're like, the market's down today. And then they say the blank dropped by 30 points. The Dow. Now, here's the problem with the Dow. How many stocks are in the Dow Jones Industrial Average? 30. Now, 30 versus 500. Do you see the first problem? The second problem is this. It's price weighted. In other words, a stock with a higher price is more important in the Dow Jones Industrial Average than a stock with a lower price. Now, I could have an extraordinarily small company and it only has one share of stock outstanding, and that would make it the most valuable stock in that Dow Jones Industrial Average if it were included in those 30. But it's the least important as far as the overall world economy. And so that's a problem with the Dow Jones Industrial Average. I wish people would just forget about it. Now, what's the problem? How did it even come to be? Well, the S&P 500 was put together by sound financial thinkers who understand things like this. The Dow Jones Industrial Average was put together by a journalist. Do you start to see the problem? In the U.S., if you're bright, but you cannot do math, you become a lawyer. But if you're not quite that bright, you become a journalist, right? And so we've got a journalist here coming up with one of the most important measures of the economy. It's just kind of jacked up. Okay, so we're going to use the S&P 500. The question becomes, how many years of return data do I use? If you were talking to a statistician and you're determining how big a sample you should use, the statistician will always want you to go with smaller or larger. Yeah, they're like, well, the bigger the sample, the better your estimate's going to be. And we have S&P 500 pricing information all the way back to January 1st, 1926. And so a statistician would tell you, well, we should use it all the way back. But here's a problem. Do you think the United States economy, which the S&P 500 is supposed to reflect, has been the same since 1926? No. 1926, my grandfather was 11 years old. His family and most everybody else's families were farmers. We were a largely agrarian society. move forward to the 1940s. What happens in the 1940s?
World War II.
World War II. And what does that lead to? What change does that make in the U.S. economy?
It's a lot more industrialization.
Yeah, so we move away from being largely agrarian, now we're largely industrial. And that happens all the way through the 50s and the 60s into the early 70s. And then in the 80s, we got into something we called the service economy, where we weren't making stuff, we were providing services. Now, these services, we still make, in fact, we have a trade surplus in services because we have lots of American companies that provide like accounting services, things like that to people around the world. So that's service economy. Then you move forward, and today, what kind of economy do we say we're in? It's an information economy. Take a look at the biggest companies. Facebook. What's Facebook all about? It's information, right? And what about Oracle? It's information. And so that's the current era. Now, thinking back, do you think that the S&P 500's average return during that agrarian time frame would be the same as during the industrial time frame? Nope. Would it be the same in the service time frame as it was during the industrial time frame? Nope. Would it be the same in the information time frame versus what it was in the services time frame? No. And what do you think is going to come after information? What's the big buzzword right now?
AI.
AI, right? There's something going on here that's going to fundamentally shift the economy. No one's come up with a good name for it yet. Maybe you guys could figure that out and become famous for naming what the next thing's going to be. Okay, so it's a judgment call. How far do I look back? And then how do we find that market risk premium? We're going to subtract the risk-free rate from the return on the market portfolio. By the way, you have to go back the same amount of time on both of them. So if I'm going to use 20 years worth of S&P 500 data, I'm also going to use 20 years worth of the risk-free return data. Questions so far? Okay, so we can estimate the beta using linear regression. And I mentioned in an Excel example here. Hopefully you guys have actually have you used Excel to do linear regression? Have you ever found beta using Excel? Okay, so that's how we would go about doing it, through linear regression in Excel. However, something you have to know is that betas tend to vary over time. I have a pretty good illustration of that here in a little bit. So just like we looked at, how far back with the S&P 500, we need to think about what period of time do I want to look at the beta of the firm. And the reason betas change over time is because firms change over time. If you roll back in time, General Electric was all about building big steam turbines and things to create electricity. But over time, their business changed, and then recently it broke up. The beta will change as the firm changes, because that means that the risks that the firm faces also change. If a firm doesn't change what they do over time, what do you think is going to happen to their beta? I'll give you an example. Right now, let's say I start a firm and it's all about AI. What do you think my beta is going to look like? Is it going to be high or low? Yeah, it's going to be high. By the time you guys retire, the whole idea of AI is going to be rather ho-hum. What do you think is going to happen to beta for that firm over time if they just stick with AI and nothing else?
It's going to decrease.
Yeah, it's going to decrease. And you can actually go back and look, and we'll see it here in a little bit. But with tech firms, they start out high beta, but if they just stick to their knitting, eventually that beta comes down because the risk becomes less and less. Okay, so the problem is this though. So I could get the very freshest estimate of beta by just doing, say, the last year. But the statistician would tell me you're better off with a larger sample size, so maybe 5 years or maybe 10 years. And so there's this trade-off between the freshness of your beta estimate and the statistical sample size. And so something that the book says we should try, I will get to that in a minute. The book's going to suggest a technique, and then I'm going to illustrate to you why that technique is flawed. But first, let's talk about the change of Microsoft's beta over time. We have 4 different time frames here. We have 93 to 97, 98 to 02, 03 to 07, and 08 to 12. And the first thing I want you to notice is the blue line. The blue line represents that linear regression that we're performing between the return on the stock and the S&P 500 return. And the slope of that line is beta. The steeper that line is, the higher beta is. The shallower it is, the lower it is. The next thing I want you to notice are all those little black dots. Those black dots represent data points. Now, how well do those lines actually fit the data points? It depends on the time frame, doesn't it? So we've got some time frames where, let's say 98 to 2002. The line looks like it kind of goes with the dots. But let's look at 2003 to 2007. That's just a big mess. Anybody here ever shoot a shotgun? You guys know the difference between a rifle and a shotgun? A rifle shoots a single round. And when you shoot the target, it leaves a single hole. When you shoot a shotgun, what happens?
Yeah, like 20 holes, depending
on the size of the shot, right? So let's go with double-aught buckshot, like the police use to bring down bad guys. 9 shots, 9 round pellets in each shell. So I pull the trigger once. How many holes show up on the target? 9. Now this is more like bird shot. This is like you might use on doves or ducks or something like that. But look at all those spots. If I go out with a shotgun and I shoot a target, I'm going to come up with something that looks like that. Would a linear regression of those dots be useful or meaningful?
Not super useful.
No. And so what I'm getting around to telling you is that this linear regression we do to come up with beta is just another swag. It's just another swag. And so you're going to find this beta, and then we're going to turn around and treat that beta like it's gospel. And what I want you to understand is that that beta that we've got is just an estimate. It's just our very best guess. And so if we come up with, let's say that we use this to come up with an estimated required return, and then down the road we use that to come up with an NPV, and the NPV is positive 12 cents. Should we accept the project according to the theory? Yeah. Should we accept the project in reality? No. That is a thin freaking NPV to be throwing, and especially if the investment's something like $100,000 and you've only got a 12-cent NPV. Knowing what we know about our estimates, no way, man. No way would I take that. Okay, now I want you to notice something here. 93 to 97, the beta is 1.28. Is that more or less risky than the overall market? More. What's the beta of the overall market? 1. Okay, so then we go to 98 to 2002. Does anyone know what that time frame was known as? Yeah, it's the dot-com bubble and bust, right? And so what we see there is anything that was computer related was up higher to begin with and then dropped faster. So the betas were higher in that time frame. And then 2003 to 2007, we see the beta dropping to 0.86. Is that lower or higher than the overall market? It's lower because by that time, Microsoft has become somewhat like a utility. Think about this. During that time frame, if you bought a computer, what was 97% likelihood was the operating system? Windows. And Windows, what was 97% likelihood of your productivity suite?
Office.
Yeah, Microsoft Office. And so they basically have this great thing going on where they were just bringing in cash flows over and over again. Not as much risk there. And we see that it doesn't get much riskier 2008 to 2012. Any questions about how these things vary over time? Okay, now, your book says, remember we talked about having to trade off the freshness of the estimate and the sample size. And the book says, oh, wait a minute, you can have your cake and eat it too. All I have to do is find, say, 4 other firms that are doing exactly the same thing that I am and look at their betas over the last year and then just average their betas and I'll be good to go. Why should that work? Because if they've got the same business risk and they've got the same capital structure, they should have the same required return, they should have the same beta. It all makes perfect sense. It sounds great, but I'm going to demonstrate to you why it's not necessarily so. So they're telling us that we are a software company and we are trying to find our beta, and instead of going back over, let's see, 1, 2, 3, 4, 5, 6, 7, 8, 9, let's say there's 12 up there, or 10. Instead of going for my last 10 years worth of data and figuring my beta, what I'm going to do is I'm going to look at these competitors that are in this business, and I'm just going to take the equally weighted average of their betas over the last year. So my sample size in theory is just as big, 10 firm years, but it's all really fresh because it all just happened over the last year. Now I'm going to demonstrate to you why this is a total crap argument. First of all, remember we said we're a software company. Is Microsoft a software company? People say yes, but I'm going to ask you, who makes the Xbox? Microsoft. And is the Xbox software or hardware? Hardware. If you have a Ford with one of those sync systems in it, Microsoft makes that. That thing's hardware. And so we kind of have to throw Microsoft out because it's a combination of software and hardware, so it's not going to work for us. What about Apple? Is Apple a software company? Yeah, it's just like Microsoft. Now, it's more heavily hardware than Microsoft, but it's still a mixture of the two, so we've got to throw out Apple too. Then we have automatic data processing. You guys may be more familiar with it as ADP. If you work for a small to medium-sized enterprise, if you look at your paycheck, you may see the stub says ADP. Have you guys ever seen that on your paycheck? Okay, so let's talk about what ADP does. They actually have created a website and a software where firms go and they put in the information about the employees, so like your age and other stuff, where it helps to decide how much they need to pull out of your paycheck for insurance, union dues, all sorts of things. And so the company then goes in there and beyond just setting up a profile for you, then every pay period they go in and they put in the information about how much you're supposed to get paid. So they'll put in the number of hours, it multiplies by your hourly wage, it figures out about overtime, it figures out all this kind of stuff. And then ADP has access to the company's bank account. And so what they will do is pull the gross pay out of the company's bank account, and they'll send the appropriate amount to the federal government for your tax withholding. They'll send the appropriate amount to the state government for your tax withholding. They'll send the appropriate amount to your union for your union dues. They'll also send the appropriate amount to your insurance company for your insurance premium. So anything that's coming out of there, they'll pull that out and send it to the right place. And then what's left over, that's what you get. And it's either going to come to you as a paycheck or as a direct deposit. In fact, the last company I worked for before I went to doctoral school, we used ADP. And the checks always showed up on Friday in the FedEx box. And we would be watching. And with our faces up to the window waiting for the FedEx man because we knew that's where the checks were coming in. Now I'm going to give you a management tip here. Should you hand out pay stubs to your people directly or allow your assistant to do it? Mr. Rollins, what do you think?
Directly.
Directly, why? You're right.
I don't trust other people.
Okay, Ed, you're right, I don't trust other people either. But there's a more important reason. So, the first time this happened to me, the first time I'm a supervisor, and they bring in the checks, and my right-hand man, Carl, he's like, hey, the checks are in, should I hand them out? I'm like, sure. And he walks away, and the other three people who have the same job as I do for different groups, their mouths are hanging open. They're like, dude, you don't do that. I'm like, what? They said, you always hand out the checks. I said, why? They said, these people need to understand that everything good in their life comes from your hand. And they need to understand, more importantly, that you can take it away. Does that make sense? So when I was in doctoral school, some kids moved in next door, college kids, and they said, oh, we're getting a puppy. I said, oh, that's great. What kind of puppy are you getting? And they said they're getting a pit bull. Now, is that good news? No. So my very next move was to buy a box of puppy biscuits. And every day after I got home from school, I would go out to the fence and I would go, Killer! And Killer would come to the fence and I would feed Killer a puppy biscuit. It's the same idea. Do you think that put me in a special place in Killer's heart? Yeah. Do you think that means it's less likely Killer would take off my arm? Yes. Right? So it's the same idea for different reasons. Okay, so ADP. We've discussed what they do. Would you say that they are a software company?
Yes.
I would say they're a business services company because the only software they really created was that web portal. Everything else they're doing is a service they're providing to business, so we're going to have to throw them off the list. And by the way, down here at the bottom, you see Paychex Inc. If you just had to guess, what does Paychex Inc. do?
Probably the same.
Same thing as ADP, right? So we're going to throw them off the list too. Then we've got Oracle. Does Oracle sound like a software company to you? It does. What's Oracle's big business?
Cloud.
Yeah, it's databases, right, is their thing. And then now those databases are on the cloud. Okay, so we could say that they're kind of a software company, but I do know that they also own Sun Microsystems. And I don't know if Sun Microsystems still makes it or not, but I do know they used to make hardware because the CAD scope I used when I was in engineering school was a Sun Microsystems scope. And so that is hardware, so we'll throw them off the list too. And then we've got computer sciences. Not sure what they do, so we can leave them on the list. CA, Computer Associates, they basically provide support for software where the company has died that created the software. There are a lot of these orphan softwares out there, and that's what CA does. Now, in their business, they're working with software, but are they actually creating and selling software? No, they're just kind of keeping people's systems crippling along, so we'll throw them off the list too. Fiserv creates software for financial institutions. So far, they sound like a pure software company until I tell you that they also clear credit card transactions. So they've got this service side too. So we're going to throw them off the list. Then we've got Accenture. Accenture doesn't create software. They help people implement software. So it doesn't matter whether you're using Oracle or SAP, they're agnostic. They'll help you integrate it into your business. So once again, they're more business services than software. So we're going to have to throw them off the list. And then we have Symantec. What does Symantec do? Antivirus. It's antivirus. In fact, Norton, I think, is a Symantec product. Now, let's assume that it is purely a software company doing antivirus software. What is the most likely software that you will keep up to date on your computer? Is it going to be Microsoft Word? I have a copy of Microsoft Word 2003 somewhere that will still do darn near everything that my current one will do. So if times are tough, am I going to upgrade that one? No. What about my antivirus? That's something that I should be upgrading on a constant basis. And that's why the beta is so low on Symantec, because we know good times are bad, people are basically going to update their antivirus. So even though it is a pure software company, unless I'm doing antivirus software, I'm not going to use that beta either. So basically what I'm telling you is this argument that you could find an equal weighted value of beta from other firms in the same industry is crap. So don't buy into that. It's not realistic. Questions? So now let's talk about business cyclicality and beta. So there's the business cycle where, and we could talk about the economy overall. The economy grows and the economy contracts. What do we call it when the economy contracts more than 2 quarters?
Recession.
Yeah, it's a recession. Okay, so we've got this business cycle. And there are some businesses that do better when times are good and worse when times are bad. And we say those companies are cyclical or pro-cyclical. And so just some examples of cyclical firms. What about automobiles? Do you think automobiles would be cyclical? Yeah, do you think people are more likely to buy a car in good times and more likely to hang on to their old car in bad times? Absolutely. Now, what about even within the auto industry? Do you think some are more cyclical than others? Yeah, people like BMW is more cyclical than Toyota because people tend to, if you have to replace your car in bad times, what's more likely, your target vehicle, a BMW or a Toyota? It's going to be the Toyota, right? Okay. Now, there are some firms that go the other way. So, for example, cheap liquor. Let's say that you own a distillery and you turn out the most disgusting rot gut, pure grain alcohol liquor, and you sell it for cheap. When times are good, what does your business look like? Bad, right? Because people can afford better. They don't have to put up with your nasty paint thinner type liquor. But when times are bad, can people afford Crevassier? No. So they end up drinking your stuff. So your stuff is counter-cyclical. And you might see other things too, like ramen noodles, mac and cheese. They all do better during bad economic times. I'm talking about the instant mac and cheese that comes in the box. Okay, so those are counter-cyclical. But we have to keep in mind, and by the way, the cyclicality is going to feed into beta. But we need to remember that cyclicality and volatility are not necessarily the same thing. So if you follow the bouncing ball from the economy to the business cycle to the sales of the firm, then that is like systemic risk. It's how your business is responding to the overall economy. But what about, let's talk about a different kind of business here. What about a movie studio? Movie studios' earnings are volatile, meaning that they're higher, lower. But is it necessarily related to the business cycle? No. Why are movie studios' earnings not cyclical, volatile? Why are they volatile? What determines their cash flows?
Their movie release.
Yeah, movie releases. And so if they're going along and releasing a great movie, I don't even watch movies anymore. So I'll just say, so what's a really big movie that's come out lately?
One battle after another.
What's that?
I work at a movie theater. One battle after another.
One battle after another. Okay, so this one is it grossing well?
No.
Oh, so that's a bummer.
No, but it's a really good movie.
Okay.
Yeah.
I'm a finance professor. To me, a good movie's one that makes a lot of money. I'm sorry to be so crass. Okay, so what's the last blockbuster you can think of? Yeah, some Superman crap, right? Or some Marvel comics or DC comics is one of those things, right? Now, so you could turn out something like that and have really high cash flows. And then the very next month, let's say you're Disney. Disney owns one of those, DC or Marvel, right? And so they come out with those movies and it's all going great. And then they drop a turd in the punch bowl. Let's call it Snow White. Have you guys heard of the recent Snow White movie? Have any of you actually seen it? Exactly. And so they throw this movie out there and it's a total dud. What does that do to the cash flows? It's down. Did people not go Snow White because the economy sucked? No. Did they go see Superman because the economy was great? No. So that's just volatility. It's not cyclicality. Which of those two things is going to impact beta? Bless you. Volatility or cyclicality?
Volatility impact.
No, so volatility, remember, and I'll demonstrate it to you. Remember that only systematic risk goes into beta.
Okay. So,
Can I diversify away from a turd like Snow White?
yes.
Yeah, how would I do it?
Just go.
Buy the stocks of all the movie studios, right? Because what are the chances that they're all laying an egg at the same time? So now I can diversify away that firm-specific risk, and what's left over after that is cyclicality, or that I can witness as cyclicality. By the way, movies tend to be countercyclical for the same reason that cheap alcohol is. Do you know what it is?
Needing a distraction, maybe?
Yeah, it's an escape. Now, I'm not recommending either drinking cheap alcohol or going to the movies. Or you could go to his employer and drink alcohol and watch movies at the same time and get perhaps a double escape, right? But that's why movies are slightly countercyclical. But if you look from studio to studio, what you see overall, overwhelmingly, is volatility. Okay, so let's talk about how business cyclicality impacts beta. So where we're going to start at here is the economy. And as the economy improves, at a firm that is pro-cyclical, we will see sales improve. Does that sound right? And so what's moderating this relationship is business cyclicality. Now the next thing that we need to do is figure out how these sales are impacting the profits at the firm. If sales are up 30%, does that necessarily mean that profits are up 30%? No. And so this is where we get to something called operating leverage. So operating leverage is the sensitivity of profit to sales. So it's the change in profit divided by the change in sales. If I've got an operating leverage of 3, It means for every 1% that my sales go up, my profit goes up 3%. By the way, what goes into operating leverage? It's the mixture of fixed and variable costs at the firm. If I have a business that has no fixed costs whatsoever, it's entirely variable costs, then I have to, if I want to improve my profit by 10%, I have to sell 10% more stuff because my cost is the same for each and every unit. However, if I've got a bunch of fixed costs, what happens to the amount of fixed costs in each unit as I make more and more stuff?
Decreases.
Yeah, it decreases. And so there is some possibility there that I can have a bigger increase in my profit because I am getting away from these fixed costs. So let's give an example here. Some of you watched the show How It's Made, and one of them was how to make luxury leather Swiss watch bands. Now, I was expecting to see some sort of high-tech facility, but it wasn't. It was some Swiss dude at his kitchen table, and he had some leather, he had some tools, he had some glue, he had some thread, and he had some buckles, and that was it. Almost all of his costs were variable. If he wanted to improve his profits by 10%, he had to increase his production by 10%. Now, what about a watch band factory in Vietnam? Vietnam, they've got a machine, and they're feeding all these cowhides in one end of the machine, and the machine's going and shooting the finished watch bands out the other end. You got one guy feeding in the cowhides, actually two guys feeding in the cowhides, and you've got a guy over here at the other end, and it's his job to just change out the box when it gets full. What do their fixed costs look like versus their variable costs?
Fixed costs are higher.
Yeah, the fixed costs are higher. Now, what that means is that they're going to have to produce a certain amount of watch bands until they break even. But after that point, basically that contribution margin becomes pure profit. Do you guys remember what contribution margin is? It's the price minus the variable cost. Contribution margin is price minus variable cost. And so the variable cost is the total cost for the person with no fixed costs. But for someone with fixed costs, the variable cost only represents a portion of the cost. In the beginning, that contribution margin is being used to cover your fixed costs. But after I've covered that fixed cost, then after I hit that break-even point, then every bit of contribution margin then becomes pure profit before taxes. What does that mean? It means that there's this opportunity now that I can have an operating leverage greater than 1. By the way, if a firm has only variable costs, no fixed costs, their operating leverage is 1. If a firm has only variable costs, their operating leverage is 1. It's kind of like a firm having only equity in their capital structure. Their operating or their equity multiplier is 1. It's the same idea. But the more fixed costs that I put into this cost structure, the higher that operating leverage climbs. And the same is true for adding debt to the capital structure, the higher that equity multiplier climbs. So, if I've got a bunch of fixed costs, maybe my operating leverage is 3. And now it only takes a 10% increase in sales to produce a 30% increase in profits. Does that sound good? It sounds good until we start talking about a decrease in sales. If the firm has no fixed cost, a decrease in sales of 10% will have what impact on the profit? It's going to go down by how much?
30%.
No, if they've got only variable costs, they got no fixed costs. If their sales go down by 10%, what happens to their profit?
10%.
Yeah, it goes down by 10% because their operating leverage is 1. But that other firm, if they have a sales drop of 10%, now their profit drops by 30%. Let's give a real example here from the automotive industry. If I mention the words Japanese car factory to you, do you picture robots or humans?
Robots.
Yeah, robots. And that was the picture that we all had of Japanese manufacturing in the 1980s, and it's still true. Unless you come to one of their American plants. Because, strangely enough, Americans are cheaper labor than Japanese, especially when you get into rural Ohio, which is where the Honda plant was that I visited. And I was shocked and amazed to see all these workers swarming over the production line like bees. They just had tons and tons of workers. Now, what would happen if you go to a General Motors plant? You think you're going to see more robots or more people? No, robots. And the answer comes down to their labor costs. Honda's workers are non-union. Now, they still make a darn good wage for rural Ohio, but it's nothing compared to what people at a GM plant get paid. And so, hopefully you guys remember from economics about trading off labor and capital. If labor's cheaper, what do I use? Labor. But when labor becomes more expensive, then it becomes more cost effective to start to use capital. In other words, equipment. I'll give an example. Think about Taco Bell. How do you place your order at Taco Bell now?
Mobile app.
Say again? The mobile app, that's one way. Let's just say that you walk in there at 2 in the morning like most of their clients and you're stoned. Like most of their clients. How do you order? Yeah, the screen with the... Now, do you think that screen was put in there for your convenience? No. Those screens got put in there because a bunch of crazy people started advocating for fast food workers to get paid $15, $20, $25 an hour. And instead of fighting it and look like they were trying to put their heel on the working man, what did McDonald's and Taco Bell do? They put in that automation. Now, I will say I truly enjoy ordering from the kiosk, especially when I'm in a different country, because they usually have a button that allows me to order in English, which is pretty cool. But the thought here is the reason that those machines suddenly started to make sense is because the labor became expensive. GM's labor is union labor. It's much more expensive, so it makes more sense to put robots in a GM factory. So now compare the variable costs at Honda, or the fixed costs at Honda versus GM. The fixed costs at GM are much higher. Let's say that per shift, they only need 12 people to go around and keep the robots greased, that sort of stuff. At Honda, they had 5,000 people on a shift. Let's say that they're both running 2 shifts. That means Honda has 10,000 workers, GM has 24. Now, when it comes time, when there's a boom, how do you get a manufacturing operation to produce more? You guys probably don't know this because you've never worked in manufacturing, but we typically run on 2 shifts. We have a day shift and we have an evening shift, and if things get really hot, we add a 3rd shift. And so then we're running 24 hours a day. Now, what happens at Honda when they add a new shift? What do they have to go out and do?
Find people on the workers.
Yeah, they got to find 5,000 people, right? And so their costs go up quite a bit. How many people does GM have to find? 12. So, all these new sales that are being brought in by this 3rd shift, which is going to be more profitable? The sales from that 3rd shift at Honda or the sales from the 3rd shift at GM? GM. That's how fixed costs lead to this higher operating leverage. Now, let's run it the other way. The boom's over, we're back to 2 shifts, and then suddenly we have a financial crisis or a COVID, whatever, something that clamps down on things. And suddenly we have to drop our second shift. Now we're down to just 1 shift. What does Honda get to do? They get to lay off 5,000 people, saves a boatload of money. What does GM get to do?
Underutilize the machines.
Yeah, lay off 12 people, and those machines, by the way, can you say, hey, Robart XR21B, grab your oil can and get the hell out? No, you're stuck with that thing. It's probably bolted to the floor, right? And so that fixed cost continues even though you're not actually making anything. And so that's why we see that this operating leverage, basically, it's going to magnify cyclicality. So whatever happens here increases the sales. And then operating leverage here is acting as the magnifier between sales and profits. So far, the most extreme thing would be a highly cyclical firm with high operating leverage. Now, where we're trying to get to here is the impact on the stock, but we can't go straight from profits to the stock. And we're talking about EBIT kind of stuff here. What is next? Actually, let's call this, what to call this? Okay, we'll call it profits. And then we're going to talk about earnings per share. How about that? Or, yeah, earnings per share. What's going to come in next is going to be the financial leverage. So remember, we talked about the mix of fixed costs and variable costs and how that impacted operating leverage. What about financing? Do we have something that we could call a fixed cost form of financing? What would it be?
Your interest payments or your.
Yeah, your debt, right? Your debt is a fixed cost form of financing. And then on top of that, we have our equity, which is the variable cost form of financing. And so the more we have of this fixed cost form of financing, the higher our leverage is. And it's the same idea. If I've got debt, so if I've got no debt, my fixed payments are 0. And all that money flows to the shareholders. If I want to increase my EPS by 10% based on my profits, if I have no financial leverage, I'm going to have to increase those profits by 10%. What if I've got financial leverage, though? It's the same idea. There's a certain amount of our business it's going to take just to be able to get us to where we can pay the interest. So we got to get up to that point. But after we've paid that interest, where does all the rest of that money flow to?
To the equity.
Yeah, to the equity, to the shareholders. And so what we can see is that for the same increase in profits, if I have financial leverage, it may create a greater increase in the earnings per share for the same change. And so, once again, what we have is a magnification. So we've got business cyclicality, magnifying what's going on in the economy as far as impacting our sales. Operating leverage is telling us how much of that's going to flow into profits. And then the financial leverage tells us about EPS. And from there, we can get to share price. Now, what's the connection here? If we can go directly from here to here, oh, no, sorry. Yeah, I know, I'm gonna stick with that. So the relationship between what's going on in the economy and the share price, actually, I'm gonna go throw one more thing in here, and that is the market. So if the economy's up, what do we expect to happen to the market? It's gonna go up too. And so what is the relationship between the market and the share price? That is the beta of the equity. And so that's how these things are linked. Now, if you just go between here and here, this is the beta of the assets. So you could have two firms that were in an entirely same business and were set up exactly the same with the same amount of fixed costs and variable costs, and their beta of the assets would be identical. But if one of them had more financial leverage than the other one, then you would end up with one of them having a greater increase in share price for the same increase in profits. Now, another name you hear this called is beta of the assets. That's business risk. That's the risk of this particular business. And it's not just this business cyclicality, it's also how we are set up to handle that demand. And so we got the beta of the assets, and then we've got the beta of the equity. Okay, now, here's the problem. So we've got a firm, and it's got high business cyclicality, it's got high operating leverage, and it's got high financial leverage. What does that tell us about its beta?
It's gonna have a higher beta.
It's going to have a higher beta. And at first that sounds great, because when the market's up 10% and you've got a beta of 3, how much is your stock up? 30%. But when the market is down 5%, what have you got? Your stock is down 15%. And so beta represents, we know this, it's risk. But, and since I didn't get to teach this class to you guys, do you know about how risk looks? It looks like a rough line when you're looking at the returns. You're going to see a lot of roughness in it. Think about beta. You've got the market doing this, and if you've got a firm with a beta of 3, what's it doing? Do you see the difference? That's what beta is risk. Okay, now, do I expect you guys to be able to replicate that discussion on an exam? No. Do you need to understand how operating leverage impacts beta? Yes. Do you need to understand how financial leverage impacts beta? Yes. Do you need to understand how business cycle impacts beta? Business cyclicality? Yes. Do you need to understand the difference between volatility and cyclicality? Yes. That's what I want you to get out of that. How do we get away from just volatility? How do we get away from having to deal with that?
Diversifying.
Yeah, diversify. We can get rid of that firm-specific risk. Questions?